Thank you, Mr. Chairman. And at the risk of redundancy, Mel, it's good to have you back. I only got to serve a year with you, but as you can see, in the year that you've been gone, I've become the second-ranking member on the Democratic side of the committee, at least for the moment. Before I ask some questions, but I would ask you to comment, I'd like to submit for the record some comments from the Homeownership Preservation Foundation regarding strengthening of the U.S. housing finance system through provision of housing counseling services. And we talked about credit score and down payment related risk mitigation factors. And as you have stated, there are other factors to be considered. We had a panel here some months ago, and I think it may have been after you left. You probably heard similar panels where we had a number of representatives from the mortgage industry talk to us about in general about mortgage lending and the risks associated with mortgage lending. And we happen to have an individual from an organization that does a lot of affordable housing work. And some of the lenders referenced that if they use the same process, which include a heavy emphasis on home ownership counseling, that they would have default rates that were lower. Could you quickly comment on that particular point? And, Mr. Chairman, if you don't mind, I'd like to have these comments entered into the record, and then I have a couple of other questions.
Without objection.
I don't think there's any question that somebody who gets good home ownership counseling, either pre-ownership or in some cases post-ownership, it makes them a better borrowers. It can't be just any counseling. It has to be good home ownership counseling, but it really has an impact because especially first-time homeowners have little appreciation for the responsibilities that go with home ownership that are different than being a renter.
It's a really important point, and I hope that as we move forward on whatever process we engage in, that we make sure to consider those factors. I'd like to turn to another somewhat related question, and it has to do with access not just to credit, but access to mortgages even for credit-worthy individuals in markets such as markets I represent. I represent Flint, Michigan, my hometown, where the average home price is $47,500. And for many legitimately legitimate borrowers with decent credit, for many banks, many mortgage lenders, mortgages of that size, they say, just don't make economic sense. And I wonder if there is anything that you are working on or could refer to us in terms of the work of FHFA that will make sure that in those markets we still have opportunity for home ownership, because otherwise we're basically consigning those communities to rent. And your point about the effect of vacant properties on surrounding values is an important one. But it's also the percentage of home ownership of those occupied properties that has a similar effect. And I wonder if you could comment on that point.
We put in the 2015 scorecard an obligation on the enterprises to work with community, smaller banks and state housing finance agencies to try to get to those lower and underserved areas, lower cost areas and underserved areas. And I think we are going to make some progress on that this year. I think the 97% loan product will have some bearing on that, although it's not specifically designed for that category of.
I would agree. In this question, we have I obviously listened as you answered questions about particularly related to down payment thresholds. I think we could all sort of agree, you don't even have to bother to answer the question, is if we decided that a 20% down payment standard would be enacted, that we would have a far lower default rate. Or if you had to have $1 million in net value, in net assets in your own personal portfolio, you might have a lower default rate. The question is, how do we balance these interests so that the maximum number of Americans have the opportunity to achieve home ownership, understanding that there are many, many ways to mitigate risk associated with people who are in a financial condition that does not allow them, because they're dealing with other exigencies in their life every day, to save the kind of money that it takes. One of the ways, and I would just, you may comment on this, you may not be able to because of the rulemaking process, but the membership standards question for a Federal Home Loan Bank is an area of some concern for me, because in some ways by limiting membership standards, we might actually cut off another source of revenue that can be directed to help some of these local community-based organizations that are working on home ownership.
And the gentleman's time has expired.